Money. Money.
And subprime mortgages coming back. Subprime mortgages were blamed for the biggest financial disaster in the century. These mortgages were provided to borrowers with sketchy credit who put little skin into the game. Following the epic housing crisis, they disappeared due to a strong new regulation and zero demand for investors who were badly burned. Barely a decade later, they're coming back with a new name. They're calling them non-prime instead of subprime. And so far, some new standards. These loans are originated and serviced and also securitized for sale by investors. Some lenders believe that there is a market today for the secondary market for people who want to buy non-prime loans. As of now, the lending industry has not gone back to the Nina loans. This is where there was no income, no asset loans, or crazy lending to borrowers with no job, but they would still lend them home mortgages. Hopefully these loans do not come back as they were the cause of the financial meltdown. But there are loans today allowing borrowers to have a FICO score as low as 500, 1 day out of foreclosure, and other challenged credit issues. The difference is they actually have to be able to verify that they have the income and the employment to qualify. U.S. subprime mortgages securities are making a comeback for sure. The issuance of bonds backed by the home loans too risky to qualify for Fannie Mae and Freddie Mac almost doubled year over year in the first quarter of 2018 to $1.3 billion from $666 million. The prediction is that subprime mortgages bonds will hit $10 billion this year, up from $4.1 billion from last year. Now, so the appetite obviously is producing more as this is growing. Some observers argue that today's subprime mortgages markets isn't as risky as it was in the pre-2008, citing new rules that force issuers to keep 5% of the bonds of their books and take stock on the borrower's financial strength. So that makes them a little more accountable and maybe a little more cautious as far as what they're lending. The current average for agency-backed mortgages is in the mid 700s as far as FICO score. Now, relaxed lending standards, even prime loans are lowering lending standards. Last summer, Fannie Mae announced it would relax its lending standards from prime loans, allowing borrowers with higher debt-to-income ratios, lower credit scores to obtain loans without additional risk overlays, such as large down payment and years' worth of cash reserves that came into play after the financial meltdown. Fannie Mae raised its debt-to-income ratio, DTI, limit from 45 to 50. Now, DTI is the amount of the total debt by the borrower compared to their income. As a result, demand from the buyers of higher debt exceeding expectations. The share of DTI loans jumped from 6% in January of 2016 to 2017 to nearly 20% by the end of February 2018, according to a study by Urban Institute. From January to July 2017, Fannie Mae purchased 80,467 loans, to be exact, with DTI ratios between 45 and 50%. But from August of 2017 to February of 2018, Fannie Mae purchased 181,911 loans in the same DTI bucket. So this is increasing more than 100,000 loans in just 7 months. The mortgage industry expectations that Fannie Mae would mitigate the additional risk with other factors like higher necessary credit scores, but that was not added, and the mortgage insurance balked since they would be on the hook for that risk. So last month, Fannie Mae relooked and did a risk assessment criteria again to make it a little safer. Now, millennials carry more debt. The outside demands from the borrowers of more debt also as well demand of the non-prime mortgages in the private sector. So just how many borrowers today would like to become homeowners but are frozen out by the mortgage market. Millennials, the largest home buying cohort today, have much higher levels of student loan than previous generations. A member of the older generations who went through foreclosures during the housing crisis or other hits to their credit are still struggling with the low FICO scores. In addition, credit tightened up dramatically. In fact, it has accounted for over 6 million missing loans, according to the research done by Urban Institute. These are mortgages that would have been granted under more normal historical underwriting standards, again, before the financial meltdown. The rebirth of the non-prime market is forced on these missing mortgages, and the hope is the industry will be able to focus on better standing underwriting and not take the risk of levels that they once did, levels that resulted in the financial market disaster. So it'll be interesting to see what happens with these non-prime, which is really the old subprime loans coming back. And I think we're going to be safe as long as they're not allowing clients that don't have jobs Are they're allowing clients that are coming in and not verifying where their income is. I think a stated income loan program is fine as long as you're working with like a self-employed buyer that has some challenges in how they're financing their tax returns. We can still keep our economy safe. So it'll be interesting to see how this all plays out for the mortgage industry. And coming up next on the Money Hour, Overcoming Overwhelm, Elise Enriquez with Elise Enriquez Coaching Consulting right here at 11:50 a.m. KKNW after this short break.